So in this video, we will look at an example of how typically I would manage a particular trade. So we will draw the base, we will draw the buy points, we will draw the range where I would look to sell the stock. And as per the guidelines and regulations of SEBI, which is the stock market regulator of India, we will look at old data. Okay, so this stock is I am looking at October 2023. We are in 2025, so this is pretty old data. But for educational purpose, I think this chart is very important. Okay, so let's just assume that this stock meets our criteria of the orange trading system. So let's assume that liquidity wise, comparative, technical, fundamental, market analysis, everything is in our favor. So we are taking a particular trade on this stock. It's a positional trade. It came in our filter. Okay. So let's approach it that way. So first thing I will do when I look at the chart is I will first draw the base. So the price is above the blue, the green and the red. The blue is the 50-day simple moving average. The green is the 150-day simple moving average and the red is the 200-day simple moving average. And if you can see inside this base, there are two mother baby candles. So if you see these two candles, that's a mother baby candle, that's an inside bar. Plus, if you see these two candles, those two again are mother baby candles. Okay, so that's two inside bars. So the probability of a breakout is very high. Now I will draw a base here. So this is 0.1 in the base, this is 0.2, 0.3, 0.4. So let's draw that. This is 0.1, 0.2, 0.3 and 0.4. So 0.3, as you can see, is in the green zone, which means it is closer to 0.1. There the overhead supply is less. So if the price breaks out on high volume at that level, that would be considered as a breakout. So let us draw a line at 0.3, which is the high of this candle, which is 2974.50. So I will draw a line which is 2974.50. This is the first step that I do. So follow this process. Now above this, I draw another line which is 1% above 2974.50. So I have a calculator here. Okay. So I'm going to use this calculator to write 2974.50 multiplied by 1.01. So 1% above, which is 3004. So let me draw another line which is 3004. Okay, so now that becomes my buying range. So when the stock enters that buying range, okay, I would be looking at the intraday time frame charts like 5-minute and 15-minute, and I will check this volume. If the volume is above the blue line on those time frames, I would be buying the stock. Now look what happens. We will go one candle ahead. See, the stock breaks out. Now the question is, for how long does the stock remains inside this yellow zone? I call this the yellow zone. So sometimes the stock might remain in the yellow zone for 5 minutes. Sometimes it remains in the yellow zone for 1 hour. Sometimes it remains in the yellow zone for 2 hours. So whatever window of time that you get, you have to make sure you complete your purchase in that particular time window. So as I said earlier, you have to buy the right stock at the right price at the right time. So normally what happens is people buy the right stock, but they get the price wrong, or people buy the right stock, but they get the timing wrong. Okay. Or sometimes you get the price or timing right, but you might get the stock wrong. So you have to buy the right stock at the right price at the right time. That is why marking these two yellow lines is important. The first yellow line is your proper buy point. The second yellow line ensures that your timing is correct. You are not buying the stock extended. If you buy above the yellow band, you are buying an extended stock. If you buy below the first yellow line, you are buying a premature stock. So the timing has to be right, the price has to be right, and the stock selection has to be as per our orange trading system. Okay. So now you will get some time window during which you can make your complete your purchase. You might not buy all shares at once, you might buy it in parts. But in this 1% range, the distance between the two yellow lines is 1%. In this 1% range, you have to complete your purchase. That can be done on a 5-minute chart, 15-minute chart. If you see a high volume candle closing inside the yellow band on a 5-minute chart, you could think of buying the stock. Now, what do you do next? The stock has broken out, the day has closed, it has been a successful breakout, high volume, so it's a genuine breakout. What do you do next? So, in this case, what I normally do is I draw two green lines above the first yellow line. So, this yellow line is the buy point. So, above this green line, above this yellow line, I will draw two uh, green lines, one at 20%, one at 25%. So let's say I get an average price of, let's say 2988.80. So I will draw a line here, 2988.80. Let us give it, say, pink color. Okay. So let's say that is our average execution price, because we are not going to get the first yellow line or the second yellow line. We will buy somewhere in the between. So 2988.80 is, let's say, our average execution price, which we get from our broker. So let us draw two lines above the pink line. One is 20% above the pink line, another is 25% above the pink line. Okay, so let's see. So 2988.80 multiplied by 1.20. Okay, so 3586. So let's put 3586. I will give it green color. 3586. So this is to manage the trade. Okay, and the next line would be 2988.80 multiplied by 1.25. So 3736. So I'll draw another line which is 3736 and I will give it green color. Okay, so now if I reduce this, see, now you have a selling range. So this was buying range, this was the selling range, because generally after any breakout, the stock is expected to travel 20 to 25% distance from your buy price before it starts to form another base. So normally there are 5 bases in a confirmed stage 2 uptrend. From base 1 to base 3, that just for the stock to go from base 1 to base 3 could take 9 to 12 months. For the stock to go from base 3 to base 5 could take 9 to 12 months. So the entire confirmed uptrend could be a period of around 18 to 24 months. And for at every base, we expect a normal and natural price movement up to 20 to 25% before it starts forming another base. Okay, I have discussed this in detail in the base counting video. I will put the link of the base counting video somewhere here. I don't know how to do that, but I will try. Somewhere near you will see a link. Okay, so watch that base counting video. That is on the weekly chart. So now let's say if we move the price, when the price enters this zone, that is when I will consider selling the stock. Okay, not all, because it's a positional trade. I might keep some shares, but out of 100, I might want to sell 75 or 80 stocks, because the stock has run up its course. It has given what we expect. Now, why 20 and why 25%? Because we keep a stop loss of 8% below this pink line, right? So 20% means reward to risk ratio of 2.5 over 8%. And 25% means reward to risk ratio of more than 3, which is 3 times 8%, right? So you are looking at a reward to risk ratio of 2.5 to 3. Now, mathematically speaking, if you are trading with a reward to risk ratio of 2.5 is to 1, then in that case, you could be wrong 7 times out of 10 and still not get into trouble. You can do the mathematical calculation later if you want. But if you are trading with a reward to risk ratio of 2.5 is to 1, you could be wrong 7 times out of 10 and still not have a loss. Okay, so that is why that 20 to 25% range is consistent with the reward to risk that we expect from the stock. So let us move. Now the question is, how long does the stock spend in this green zone? Now I am assuming that this is a proper positional trade. It meets all our criteria in the orange trading system. I am also assuming that in the previous 3-4 trades, before I took this trade, okay, I am assuming that I have made decent amount of gain. So that increases my ability to tolerate more risk. So I can hold on to this stock as long as it remains above the blue line. So there are quite a lot of assumptions here. And I'm keeping the assumptions aside. I want you to focus on the chart. So if we move the price forward, okay, the price starts to move. See, it's a nice, decent breakout. I'm not looking at candles with high volume weak closes here because I have decided that I'm going to take risk. See, there comes a time when the blue line crosses the yellow line, which is a good sign. And there comes a time when the stock enters that green level. See, now if you see this candle, it has entered the green zone. Now the question is, on that day, how long did the stock spend inside that green zone is very important. And you see the distance also from here till here. So it's 15 December, 27 October. So almost 1 month and 18 days have passed. Okay, so here it looks very small, but in reality, if you see, you have been waiting for 45 days for this to happen. And now that this has happened, you might want to think of selling a majority of your shares because you might buy at the next base, but currently the stock is giving you an opportunity to exit. If I take it one candle forward, let's take it a few candles forward. See, the stock gives you time in this area between these two candles. The stock must have traded in that green zone at least for, let's say, 2 hours, 3 hours time window, right? Because this is a decent distance that the stock has gone. Even this candle, it opened in the green zone. So it must have spent quite a lot of time in that green zone. So the point I'm trying to make is, if you mark proper selling band and proper buying band, there is a window that opens for buying and there is a window that opens for selling. As long as you are catching that window properly, you are doing well when it comes to trade management. And that is the objective of this video. You need to have some rough target in your mind. I am not saying that you keep your GTT sell order here. Don't keep automatic sell order here. Sometimes the stock might enter this green zone. I might not sell anything because on the previous 3 4 trades uh, I might have realized some gains which allows me to stick with this stock. Or sometimes I might put the 21-day just to keep just to remain in the stock as long as it remains above the 21-day exponential moving average. So this is one way of managing the trade. Now I have not counted what is the base count. It could be base 3, base 4, whatever. The more late the base, the more likely I am to sell here. And the more early the base, the less likely I am to sell in this area. And even if I sell, I might not sell all of my shares because I would consider this as a positional. Now, I have made a lot of assumptions before I made the video. We may have to go back and check what was the actual fundamentals at that time. But this is to illustrate to you how to draw the base, how to mark the buying range, how to mark the selling range, how to capture that buying time window, how to capture the proper selling window, because the stock gives you enough time to buy, it gives you enough time to sell. So there is no hurry here. Okay, there is no need to get restless or impatient. So I wanted to use this example, and as per the regulations and guidelines, we are using an example of the past. So this was like 1 year ago stock chart I'm using just to educate you as to how I would approach a trade. When we mark these lines on the chart, we have a decent idea as to where we want to enter, where we want to take the exit. And if the stock is giving us, if the stock is doing what we expect it to do, there is no need to take the exit. Okay. Now, what if in your previous 3 4 trades you realized a loss, or in your previous 3 4 trades you have not made any gain before you took this trade? Okay. Now, in that case, the situation is different. Now you want to look at high volume weak closing candles. Like for example, this candle, it's a high volume weak closing candle. It's a sell sign. It's a technical sell sign, right? So you might want to reduce your position size here. Plus, if you look at this high volume weak closing candle, weak closing means the candle closes below the midpoint of the candle. Okay, every candle has got 4 points: open, high, low, close. There is a fifth point called as midpoint. If the closing is below the midpoint, that's a weak closing. And high volume weak closing means probably the institutions are selling, right? So this is the area where I might want to exit the stock if I have not made money in the previous 3-4 trades. But if I have the ability to tolerate risk, then what I could do it, I would move my 8% stop loss to the pink line and then wait till the stock enters this range before I choose to sell my stock. Okay. So I hope this video helps you in managing your positions, especially the positional trades. I will see you in the next video. Thank you so much.